times interest earned, which indicates how well an entity can sustain debt by measuring its ability to meet interest payments as they become due. Also known as interest coverage ratio, it reveals the number of times interest can be covered by operating profit. This is a solvency ratio. Remember, solvency is the availability of cash over the long term to meet maturing obligations such as interest. The higher the interest earned ratio, the better able the entity is to fulfill its interest obligations. From this description, we can get an idea about the formula of this ratio. Operating profit, or the profit before deducting the interest expense and income tax, divided by the interest expense. Even the name of the ratio gives us a clue of the formula. Times interest earned. The denominator is the interest expense, while the numerator is the earnings or profit, but not the net profit or the net income. Also not the gross profit or gross income, but the operating profit or earnings before interest expense and income tax. The income statement of Elizabeth Tailoring Materials Store shows interest expense during the year of 150,000. How about the operating profit or earnings before interest expense and income tax? We have two ways to compute for that. The first is the gross profit minus the operating expenses. So, 8,070,000 minus 3,800,000 and minus 2,500,000 equals 1,770,000 operating profit, which should be our numerator in the formula. The second way to compute for that 1,770,000 numerator is the net income of 1,620,000, then add back the income tax, although there is none in this income statement, and also add back the interest expense of 150,000. That would give us the same amount of 1,770,000 numerator. That's why it is known as profit before interest expense and income tax. We add back the interest expense and income tax to the net income. Before we proceed any further, let's make the computation of the numerator clear. Profit before interest expense and income tax. This means profit before deducting the interest expense and income tax. Because the net profit or net income is already after deducting the income tax and interest expense, to get this numerator, we have to add back the income tax and interest expense to the net profit or net income. That's why 1,620,000 net income plus 0 income tax. Then plus 150,000 interest expense equals 1,770,000. Then to get the times interest earned ratio, we have to divide it by the interest expense of 150,000. And that is equal to 11.8 or 11.8 times. the entity can well afford to pay its interest obligations, its operating profit being 11.8 times as much. Another important thing you should know is that aside from the interest expense and income tax, some financial analysts prefer to add back also other expenses which do not require cash payment or cash outlay, such as depreciation, depletion, and amortization expenses. They reason out that adding back also those non-cash expenses to the net income would result to the numerator becoming a better estimate of the amount of cash generated from operations which is available for the payment of interest expense.